Welcome to The Explainer. Today, we are breaking down Omnicom's recent earnings, and this was one of those quarters where you really had to look past the headlines. I mean, the numbers on the surface told a completely different story than the market's reaction. It looked messy, for sure, but it also signaled a really bold new chapter for the company. Okay, so let's start with the good stuff. Omnicom reported revenue of $5.53 billion, and that just smashed what analysts were expecting by nearly $500 million. A huge top-line beat like that was really the first clue that something big was going on here. But, and here's the twist, on an adjusted basis, they actually missed their earnings per share target by 9 cents. And if you look at the official accounting numbers, whoa, it was a massive, multi-billion-dollar loss. So this brings us to the big question, right? You've got an official loss and an earnings miss, so why on earth did investors pile into the stock and send it flying? The answer is all about looking past the short-term noise and really understanding the strategy. All right, let's get into it. To really get why the market reacted the way it did, we have to unpack all the huge strategic moves happening behind the scenes. See, this wasn't just any old quarter. This was the first one that really reflected their massive acquisition of Interpublic Group. Now, what's so fascinating here is this huge gap between the official GAAP loss and the adjusted profit. Management basically took what's called a kitchen sink approach. They pulled forward over $1 billion in one-time costs to get all the bad news out of the way at once. This is a classic move from a really confident management team. Instead of letting bad news just drip out over time, they take all the pain in one go, which gives them a clean slate to build on. It's a signal that they are ready to execute. And we're not talking about small adjustments here. I mean, they took a hit of over $1 billion for things like severance and consolidating real estate, then another $500 million loss for selling off parts of the business that weren't core to their strategy, what they call dispositions. This was all very deliberate, all designed to get the new combined company on solid footing right from the start. So here's the key takeaway. This smart money, the sophisticated investors, they looked through all that short-term manufactured pain. They were focused on the long-term gain because they saw some really clear signals pointing to a much stronger future. Let's break down exactly what those signals were. First off, management showed incredible confidence by doubling their target for merger synergies. Now, synergies is just a fancy word for all the cost savings you get from combining two big companies. Getting rid of duplicate jobs, consolidating office space. They went from an initial target of $750 million to a massive $1.5 billion. And get this, they plan to capture a staggering $900 million of that this year alone. And if you want proof of their conviction, look no further. They backed up all that talk with a massive $5 billion share repurchase program. This wasn't just a promise for later either. It included a $2.5 billion accelerated buyback, which is a huge signal that they believe their own stock is deeply undervalued. They're literally putting their money where their mouth is. And well, the market heard that message loud and clear. Investors looked right past the messy accounting number, they understood the forward-looking strategy, and they sent the stock soaring over 13% the very next day, on way higher than average volume too. You could see Wall Street analysts connecting the dots immediately. UBS, for instance, put out a note saying that the aggressive synergy targets and that huge buyback would lead to a meaningful uplift to earnings in the future. They saw exactly what management was doing. Okay, so let's put on our analyst hats. What does all this mean for the stock going forward? This is the next call, where we give you our take on what to expect. Our core thesis here is pretty simple, actually. The market is betting on this management team, plain and simple. It's rewarding their aggressive, decisive action to get this integration done right, and it's focusing on that powerful 1-2 punch of cost savings and capital returns. So based on all that, we are initiating our coverage with an outperform rating and a $95 price target. We think those aggressive synergies are going to drive margins higher. The buyback provides a really strong foundation for their earnings per share, and the whole company is now refocused on higher growth areas. Now, if you want to track this thesis with us, there are a few key things to keep an eye on. First, their upcoming Investor Day on March 12th is going to be huge for getting more detailed guidance. After that, you'll want to watch the pace of those cost savings hitting the bottom line and how they're progressing on selling off those non-core businesses. And as always, this is not financial advice.